What is a stop-loss order? A stop-loss order is an automatic trade order that specifies an investor wants to sell a given stock, but only at a specific price level. It can limit losses and lock in gains on stock. How stop-loss orders work. An investor deploys a stop-loss as an essential automatic trade order to their brokerage. The trade executes once the price of the stock in question falls to a specified stop price. Such orders are designed to limit an investor's loss on a position. For example, you are long on 10 shares of Ford Motor Company, F, which you bought for $8 per share. The shares are now trading for $10 each. You want to continue holding the stock, but don't want to lose all of the unrealized gains you have built up so far with it. After a review of company data, you decide that you will sell your position if F shares fell to $9. So you could input a stop-loss sell order to your brokerage to sell 10 shares of F if the price falls to $9. What price is used to trigger the stop-loss? The prevailing market bid price are used to execute the stop-loss order. If the bid price reaches the specified stop-loss price, the order is executed and the shares are sold. Let's look at our example again. A stop-loss order placed for 10 shares of F at $9 would effectively limit your potential losses, and you would realize a profit of $1 per share should the stock price drop. $9 market price less $8 cost basis equals $1. Pros of stop loss: set it and forget it, locks in profits, limits losses, costs nothing, avoids emotional/pressurized decisions. Cons of stop loss: limits gains, could be activated by a temporary price drop/flash crash. Realized sale price could be lower than the stop price. Not suited to volatile stocks. A stop loss versus a limit order. A stop loss order triggers when the stock falls to a certain price. Then, technically, it becomes a market order, which executes at the next price available. In a volatile situation, the price at which you actually sell could be much lower than anticipated, causing you to lose more money than expected. On the contrary, a limit order trades at a certain price or better. The limit order ensures that you do not execute the trade at a lower price than anticipated. Limit orders cost more in trading fees than stop-loss orders. Plus, limits also have a time frame horizon, after which they automatically cancel. This time limitation may cause it to cancel before it is executed if the price never reaches its trigger point. A hybrid of the stop-loss order and a limit order is the stop-limit order, which combines the features of the two. When the stock reaches a specific price, it triggers the trade as a limit order and trades only at that price or better.